Interactive brokers pays a yield of over 4% on our idle USD funds, which sounds nice until you realize that this doesn't apply to the first 10,000 US dollars. So if you have like $5,000 or even $10,000 in the account, your money is just sitting there doing nothing, like a lazy bum bum. And even if you have more than $10,000 in the account, due to how IBKR calculates the interest, you will always end up with a much lower interest than the advertised 4% interest. That's why in this video, I'll be showing you how you can easily earn a much better return on your idle cash in IBKR while having the money ready to invest whenever you need to buy stocks. But before that, if you don't have an IBKR account yet, you can use my link to sign up and enjoy super low trading commissions, yeah? Alright, one of the most obvious solutions to earning a 5+% return on your USD funds is to just park the money in a low-cost broker's cash management account, like Momo Cash Plus, Tiger Watch, Weeboo Money Boo. This is perfectly fine if you aren't planning to use the money to invest via interactive brokers. But if you do intend to invest via interactive brokers, this is a huge problem because you will need to redeem the funds first, wait 1 to 2 days for the money to be settled, convert the currency to SGD, transfer the money to your bank account, transfer the money to interactive brokers, wait half a day, convert your money to USD, only then you'll be able to buy stocks. By then the stocks will have already gone to the moon though. So what's the alternative? Someone suggested parking the money in UST bills. While this method is good for locking in high yields for up to 12 months, this is not the best strategy if you need the flexibility to invest your money anytime. Because even though you can sell your T-bills to get back your money, every trade will cost you $5 US, which is super expensive, yeah? And on top of that, you may end up losing a bit of money due to the wide bid-ask spread. So a better option would be to invest the money in either government bond ETFs or money market ETFs. And for this, after scouring through the internet, I found several contenders, namely the CSOP USD Money Market ETF that's listed in Hong Kong, USFR, SGOB, TFLO, IB01, ERNA, and VDST. So let's do what we do best and compare these ETFs to see which is the best one to go for. First up, all the options here are denominated in US dollars. So instead of looking at the currency, we should focus on where the ETFs are domiciled at because this will affect whether there's any taxes on your investments or not. For this, even though US domiciled ETFs generally have a 30% dividend withholding tax, in this case, since these ETFs hold US Treasury bonds, they are actually exempted from the dividend withholding tax. But due to how the tax system works, the broker will still withhold 30% of the dividend before paying out the rest to you, and will only refund the remaining 30% back to you in the following year, typically around the February to March period. However, the bigger issue here is that there may be up to 40% estate tax on your US domiciled ETFs when you pass away. The reason I say maybe is because US Treasuries are exempted from the estate tax, but I'm not sure if this applies to ETFs that hold US Treasuries or not. Though, I guess it's best to assume that there will be estate tax, especially on the dividend payouts that become cash sitting in your brokerage account. So, because of this, it's best to avoid US domiciled ETFs and invest in non-US domiciled ETFs instead. The next ETF on this list is the CSOP US Dollar Money Market ETF, ticker symbol 9096. The good thing about this ETF is that there's no dividend withholding tax and no estate tax. However, the downside of this ETF is that 1. Its 0.35% expense ratio is quite high when compared to other ETFs on this list. 2. IBKR charges a slightly higher $2.25 minimum fee for the Hong Kong market as compared to the other markets. And 3. IBKR doesn't support fractional shares on Hong Kong securities, and the minimum investment amount for this ETF is 1 share. So you can only invest in absolute numbers of shares. And for these reasons, I will also avoid the Hong Kong ETF, which brings us to the 3 Ireland domiciled ETFs. For this, both IB01 and VDST are almost the same, where they both hold the same 0 to 1 year US Treasury bonds, have around the same 1 year yield. The holdings have almost the same average duration, where they mature in about 0.3 years, plus both are accumulating ETFs. So all dividends are automatically reinvested without you having to do anything. which is always nice. The biggest difference here is that IB01 has a slightly higher 0.07% expense ratio as compared to VDST 0.05% expense ratio. Though this isn't a deal breaker, as we'll only be parking our money in these ETFs for a short period before investing them. Instead, we should look at the average trading volume. For this, we can see that because IB01 has a much higher trading volume, it will have a better bid-ask spread as compared to VDST. And for this reason, it's better to go with IB01. Last but not least, the iShares Dollar Ultra Short UCITS ETF, ticker symbol ERNA. Unlike all the previous ETFs which hold US Treasury bonds, ERNA holds very short maturity corporate bonds across various sectors such as banking, consumer, cyclical, technology, and so on. What's interesting is that since this ETF holds corporate bonds which have a slightly higher risk as compared to US Treasury bonds, this ETF is able to give a slightly higher 6% yield as compared to all the other US Treasury bond ETFs. And due to its short-term holdings, it's also able to give a rather smooth return over longer periods of time. But you will notice that in 2020, there was a big drawdown. As explained by Keith from Investment Modes, this was because people were panic selling during that period. As a result, the bid-ask spread widened significantly, which caused the drop to happen. And when things started to stabilize, the ETF price returned back to normal. So this is the risk that you need to be okay with if you want to invest in ERNA for the higher yield. Otherwise, it's best to just stick with IB01 where the yields are slightly lower, but the ETF is also a lot more stable. Now that we know which are the ETFs that we can go for, here's a question. If I'm parking my money in these ETFs, after selling these ETFs, how long do I need to wait before I can reinvest the money into stocks? The answer is, you can immediately use the money. This is true whether you are using a margin account or a cash account. What? Even cash account? Yes, IBKR says that if you are using the cash account, under the free riding rule, you can use the proceeds from the sale of a security to purchase a different security. But you will need to hold the second security until the initial sale is settled, which in this case is T+2 working days. This means that if you are using a cash account, after selling the bond ETF and buying a stock, you can't immediately sell the stock within 2 working days. If you do that, IBKR will block you from doing this again for the next 90 days. So take note, next. Because IBKR charges a minimum $1.70 fee for trading securities on the London Stock Exchange, you will need to make sure to park your money in there long enough to make the investment worth it, For example, if you are just investing $1,000 for just 10 days, it's better not to park your money in there because you will only be making $1.50 over that 10 days. So in order to know how long you will need to park your money in there for, the formula to use is $3.40 times 365 days divided by you and the amount. For example, if I'm parking $1,000 in there, I will need to invest for at least 23 days for it to break even. But if I'm parking $2,000 in there, I will only need to invest for 12 days instead. Last but not least, here's a quick tutorial on how to buy these ETFs so that you can earn a better yield on your idle cash. At the top, search for IB01 if you want to invest in US corporate bonds for around 5+% yield. The one that you want is the one that ends with LSE ETF. Or if you want a slightly higher yield and you are comfortable with sudden swings in the events of a crisis, you can go with ERNA, which also ends with LSE ETF. Then click on buy. For quantity, you can buy with as little as 0.0001 shares or $1. But I recommend buying a much bigger amount, like $1,000 or more. Otherwise, you will need to park your money in there a lot longer to make it worth it. As for order time, you can try to set a limit order if you want to time the price. But personally, I would just go with market order to buy it immediately. The total fees should add up to around $1.80 to $1.90. If everything is okay, just submit your buy order and you are done. So that was a quick video on where to park your money in IBKR to earn a higher return. Hopefully you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.